You received cash today, so why isn't it revenue yet? Many people think that once cash is received, it automatically becomes revenue. But is that always the case? Imagine a customer pays your business today for a service you'll provide next month. Should you recognize the revenue today simply because you received the cash? Or should you wait until you've actually earned it? That's exactly what we'll learn in today's lesson. By the end of this video, you'll understand what unearned revenue is and how to record it. Before we look at an example, let's first define what unearned revenue is. Unearned revenue is cash received in advance for goods or services that have not yet been provided to customers. In other words, cash is received now, but revenue is earned later. Notice another important point. Unearned revenue is a liability because the business still owes something to the customer. The business has an obligation to either provide the promised goods or services, or in some cases, refund the money. Some common examples include unearned consulting revenue, unearned rent revenue, and unearned subscription revenue. If you look at the visual, you'll see the process. The business first receives cash. It then records a liability because it still owes the customer. Later, after providing the goods or services, it recognizes the revenue. That's the basic idea behind unearned revenue. Now let's see how this works using Alex Consulting Business. On March 1, a client pays Alex Consulting Business $2,400 in advance for 4 months of consulting services beginning in March. How do you think we should record this transaction? Take a moment to think before I reveal the journal entry. Here's how we record the transaction. We debit cash because the business has received $2,400. We credit unearned revenue because the business now has an obligation to provide consulting services in the future. Remember, unearned revenue is a liability, not revenue. That's because the business hasn't earned the revenue yet. Although it has already received the cash, it still owes the customer the promised goods or services. Receiving cash is not the same thing as earning revenue. Revenue is recognized only after the goods have been provided or the services have been performed. Until then, the amount received is recorded as unearned revenue, which is a liability because the business still has an obligation to fulfill. Now let's move to the end of March and see what adjusting entry is needed after 1 month of service has been provided. So by the end of March, the business has provided 1 month of consulting services. Since the client paid $2,400 for 4 months, the business has now earned $600, which is $2,400 divided by 4 months. We debit unearned revenue because it is a liability. As the business fulfills part of its obligation, the liability decreases. And remember, when a liability decreases, we debit the liability account. Next, we credit consulting revenue because the business has now earned that portion of the revenue. Notice that cash doesn't appear in this journal entry because the cash was received on March 1. If the agreement continues, the same adjusting entry will be recorded at the end of April, May, and June until the full $2,400 has been recognized as revenue. At that point, the unearned revenue account will have a zero balance. Remember, recognize revenue as it is earned. Let's quickly summarize the process now. First, the business receives cash from the customer. Since the goods or services haven't been provided yet, the business records a liability. That's why the initial journal entry is debit cash and credit unearned revenue. The X simply represents the type of revenue. For example, it could be unearned consulting revenue, unearned rent revenue, or unearned subscription revenue, depending on the business. Next, the business provides the goods or services to the customer. Once the goods or services have been provided, the revenue has now been earned. At that point, the business records the adjusting entry by debiting unearned revenue because the liability decreases. Remember, when a liability decreases, we debit the liability account. Then, the business credits revenue because the revenue has now been earned. Although the account names may change depending on the business, the process stays exactly the same. Whenever you see cash received first and revenue earned later, you're dealing with unearned revenue. And that's it for this topic on unearned revenue. I hope this lesson helped you understand why receiving cash isn't the same as earning revenue. If you have any questions, feel free to leave them in the comments. I'd be happy to help. In the next video, we'll compare the liability method and the revenue method for recording unearned revenue. You'll see how both methods work and why they ultimately produce the same result.